What have you learned the last couple of weeks from the Federal Reserve members?
I think so. The most interesting one is from how the distribution of outcomes has shifted. There's two elements here. Number one, that they're coming out and saying the hurdle to raise rates is very, very high indeed. You go back just a month, the options market's pricing in a 20% chance that the next move's a hike. And now they've come out and said, actually, we don't have any intention of raising rates.
So just to confirm, this is the same market that put in 150 basis points of cuts this year, yeah?
Absolutely right.
Okay, so just want to get right there. Their accuracy levels.
So there's another piece there which says how much faith should we have in the market? When the market's pricing 6 to 7 rate cuts at the start of the year, we're saying this is nonsense, this is not going to happen. So form an independent view. But the second piece that's come out, I think, is the greater emphasis on the labour market. The past 2 years has all been about the FOMC doing whatever they have to bring inflation under control. And it's not back to target yet, but it's so much closer that they're now willing to say, look, we have this dual mandate, inflation is still really important to us, but actually we're putting more and more focus now on the labour market. And if you begin to see the weakening in the labour market that we see right now turning into outright weakness, then I think they're saying, actually, we're willing to take rates down.
So I'm really looking forward to catching up with Jonas Pricing over at Manpower this week, because he was the one that told me 12 months ago, 18 months ago, that there was just no let-up, that we still have a very strong labour market. So it's going to be really interesting to see now whether he's changed his tune, because everyone was saying, oh, surely things are getting better. And he's saying, no, they're not.
Yeah.
There's a warning. No, they're not. So his update's going to be fascinating.
Yeah, I think if you look at those labour market data, so the headline non-farm payrolls has begun to weaken a bit. If you look at the JOLTS data, the hiring and the quits ratios are not looking quite so good. Initial jobless claims are beginning to move higher. There's nothing here that suggests there's a really nasty turn in the labour market, but there's definitely a weakening. And that distinction between weakening and weakness, I think, is critical for the Fed. A weakening of the labour market takes a bit of heat out of things, allows the labour market to cool and wage pressures to come down. If it tips over into outright weakness, then the Fed's going to respond to that.
It's all nuances when it comes to monetary policy at this stage. But if you look at the market, I mean, we went down in April and we've gone right back up in May. So much for the sell in May and go away theory. That is not happening this time round. What do you make of the performance that we've seen as we keep on stretching for records on the market?
Well, it comes back to actually Steve's point here about, what have we learned from these speeches? I think what we've learned is that the threshold to actually tighten monetary policy is so high that those concerns that I think were weighing down on the market for a brief part of this year have now dissipated. So we're now in a world in which even if growth weakens, you get some relief from the fact that the Fed will adjust policy accordingly. So the market now, I think, is much more into risk-on mode. So spreads can remain tight in credit markets and equity market valuations can remain supported.
I feel like you'd have to be incredibly brave to take money off the table before the first rate cut, because this is a market that seems to have a little bit of momentum. But at what point does that momentum stall? Is it going to be the first rate cut, confirmation of the news, or is there going to be more in it because it's only the first rate cut? I mean, how do you think about the playbook around equities from here around monetary policy?
I tend to think when rates start coming down, it's going to be quite helpful for risk assets. Obviously, it's going to be all about what's the reason for why rates are coming down. Is it that we're looking at some kind of recessionary scenario, which is not the base case, or is it that actually the economy is moving back to a better equilibrium and that inflation is better under control, so rates don't need to be quite so high? I think that's the world that we're looking at right now.
One of the most useless things out there is the people who name the VIX as an index of fear. Quite frankly, it's just an insurance policy and they need to get over themselves. It's an insurance policy that no one seems to be initiating buys on. Of course, every time there's a contract open, there is a buyer and a seller. But it's traded at 11 handle. Now, have you got the VIX? Yeah, there you go. You're ahead of me, guys. Thank you. 11.99. I've got a number. Actually, you'll find this interesting. I don't know if either of you guys have seen this. The VIX is down 23% in the last month, accompanying this rally as well.
Yeah.
I would have thought the higher we go up, the more insurance people might want. But it seems the higher we go up, the less insurance people want. Any thoughts?
Yeah, I think we do move into a world in which volatility, so the VIX and other vol indicators start to move higher. The world in which we're in now, the policy outcomes, the political outcomes, the economic outcomes, the dispersion of potential scenarios is wider than it has been for some considerable time. So we would certainly be expecting, whether you have a bullish or a bearish view, wherever you are on that spectrum, the vol around that view is likely to be wider.
The story you're telling about the cutting in monetary or the change in monetary policy, the cuts in interest rates at some point being positive for risk assets, I wonder whether we're already seeing a feature of that where the market is feeling confident, but they're not necessarily putting all their chips in the United States now. You're seeing the money flood into the overlooked markets. The UK is, of course, one of them. Hong Kong is the other. So it does make me concerned that if we're already stretching for value somewhere else because we're optimistic, that the market is actually running out of steam without us realizing it.
I think the opportunity set's broadening out. I'd put it in a more positive light, but I agree with your assertion that I think in the US right now, valuations are, I think, supported by economics, supported by monetary policy, but there are perhaps better opportunities in economies like, you mentioned the UK, or perhaps Japan or India. So you've got to take a judicious view of where is value relative to fundamentals, and our assessment is that the US looks interesting, but there are probably better opportunities in other markets right now.